we're speaking primarily about home loans and education loans. Now, with the repo rate as low as it has ever been, interest rates on home loans are also at historic lows, but we are seeing a trend of rising bond yields globally, and that is being seen as a precursor for rising interest rates. My guest today, Pankaj Mathpal, the Managing Director of Optima Money Managers, is going to tell you what you need to bear in mind when you're out looking for a loan. Thanks so much, Pankaj, for joining in. I'll ask the first question, which is the most basic one. Like I said, we're possibly heading towards a rising interest rate scenario or cycle. What does one need to bear in mind if they're going out to get a loan right now?
See, when your EMI is calculated, it's based on the prevailing rate of interest. So if right now rate of interest are lower, it means your EMI for that tenure will be fixed. But because in floating rate system, rate of interest keep changing. And if rate of interest goes up, it means your tenure, if you do not change your EMI, it means tenure will be increased. So if suppose you're going for a 20 years loan right now and rate of interest goes up, it means you'll have to repay loan for more months, or otherwise you can change your EMI. So usually people do not pay attention to that. And we have seen that number of months keep increasing whenever the rate of interest goes up.
You know, we'll get into the nitty-gritties of it, but let's talk about home loans first, because this is, in several scenarios, Pankaj, the largest purchase that anyone can make, and it's certainly not a decision that you can enter lightly. Quite a few times it is an emotional decision because you move into the home of your dreams, and quite a few people have been moving into larger homes over the course of the pandemic. So what should be the determining factor according to you when you're taking a loan? Should you, for instance, in certain situations decide, no, I'm not going to take that loan right now, I'm going to save up for another couple of years and then buy a house?
See, it is very important that you should have some money for down payment. Usually banks, they grant you loan up to 80% of the value of the house. But you have to see that your repaying capacity, because as of now, because of loan rate of interest are lower, so your eligibility has increased. And in this situation, if you are able to repay the loan, you are able to afford the EMI. Tomorrow, if rate of interest goes up, and in that case, if you need to increase EMI, as I said earlier also, if you do not increase the EMI, in that case, the tenure will increase, or you have to increase your EMI. So you should keep some margin for that. So right now, it should not be like that you are taking the maximum loan, whatever possible for you. Rather, you should see the repaying capacity. If you can afford to pay the EMI of 1 lakh rupees, so right now your EMI should be say 80,000, 90,000, so that in future when rate of interest goes up, you can increase your EMI. So that should be in mind, that your repaying capacity should be in such a way that if required, you can increase your EMI.
Now, Pankaj, you mentioned a figure, but obviously this is something I think that we have to look at in terms of a percentage of your monthly income. And usually if you have a couple that is buying a house, and I'm talking about home loans here, you would have their joint income, if they are both earning, that you take into consideration, right? But should you account for the possibility, for example, that you could see interest rates go up by at least a percentage point, if not more, in even 2022 or early 2023?
Yes. So if you talk about the household income, your EMI should be something 40% maximum to that income. And as you said that right now we are in a lower interest regime. So if interest rate goes up, considering that also, if you keep lesser than that, lesser than 40%, it is always good. So if it is in the range of 30%, 35% of the household income, it is always good, but maximum 40%, it should not go beyond that.
Okay. There's another point that I want to ask you about, which is in the event that interest rates rise, which is going to happen for a lot of people. And in fact, the pass-through is going to be very quick because you have the benchmark linked loans right now. They're all linked to the repo at this juncture. what would you suggest is the best alternative between the two, between raising the EMI and increasing the tenor of the loan? Which is the better option to consider?
Definitely, I'll say increasing EMI is a better option because you'll be able to repay loan within the original tenure which was granted. But in case it is not possible, then of course that your tenure goes longer. But as much as possible, one should try to increase, even if rate of interest are constant, I'll say for example, for some time, and your income increases. So in the same line of your income, one should try to increase the EMI so that loan can be repaid as early as possible. If suppose you have taken for 20 years tenure, so you should try to complete within 20 years. But if you can repay earlier than that, that is always good. So my suggestion will be that whenever possible, with the increase in your income or whenever it is possible, you should try to increase your EMI.
What you need to bear in mind in a scenario where interest rates could rise. And we've spoken about it in quite a lot of detail already. But Pankaj, one aspect that is very important in terms of taking a very large loan, like a housing loan, is the term insurance component. Is it absolutely essential to have? And what do you need to bear in mind when you actually have to go out and buy term insurance?
But it is advisable that one should go for term insurance when you go for a larger loan amount. The reason is that in case of untimely death of the borrower, the family member should not face any difficulty. So it is better that one should go for term insurance. But usually when you raise loan, banks suggest that you should go for a single premium policy and they only sell term insurance to the borrower. My suggestion that one should go for a regular premium policy instead of going for a single premium policy. Because when you are borrowing money, that time you may not have a larger money available with you for single premium. And usually banks suggest that you add that premium amount to your loan. And if you do that, in that case, you have to pay interest on that, interest on the premium amount as well. Because if you're going for a loan of 50 lakh and 1 lakh rupees additional you have taken for premium, it means you will pay interest on 50 lakh as well as on that 1 lakh. So idea is that you should go for a regular premium. That is a better choice, and not necessary that you take insurance policy from the same bank where you are raising loan. Instead, you can compare premium and you can buy it yourself.
Okay. Now, I do want to come to education loans as well, because this, I think, is an important talking point, considering that you've seen major disruption in academia also, with a lot of people who are looking to study abroad, looking for further education. Their plans have been put on hold. But even now, if they're thinking of going abroad and studying, it's not something that is anything to sneeze at. It's a lot of money involved. What does an individual need to bear in mind if they're going out to get an education loan? And if possible, do you think that it's advisable to take those loans in the US maybe, considering that the interest rates are lower?
But is it possible to take loan in US? That is a question, because if you're resident, Indian resident, it will be difficult for you or may not be possible. So you have to take loan from your resident country. And in such case, if you're taking loan here, then you have to keep in mind that you have to repay it. So usually there is a moratorium period. You have to repay the loan only once your that education course completes and you get a job. So either after you get the job, you get 6 months from that, or otherwise 1 year after the completion of your course for that, you have raised loan. So in both the cases means if you get employment, then there is no problem, no difficulty in repaying. But in case in the adverse situation, if you don't get a suitable job and you find it difficult, then what is the plan for that? So one has to keep in mind the time of borrowing that you have to repay it. So whatever course you are doing, whatever education you are taking, it should be job oriented, and you should be sure that you will get employment as soon as you complete that education. So that one has to understand.
Okay, so that's something that you have to bear in mind. When it comes to repaying a loan, Pankaj, there are certain strategies that you can follow, right? Especially when you're talking about home loans, which span in many cases 15 to 20 years. what is the best time to prepay the loan? It's obviously in the first several years, right? And what are the strategies that you would suggest that a person can employ if they're talking about prepaying a loan?
See, one should try to repay it as soon as possible. But I understand that if you're going for 20, 25 years loan, it will be difficult for anybody to repay before 10 years. So you should keep in mind that by end of 10 years, within 10 years, you should repay it. And for that, because your salary, your income will keep increasing year by year. And if you plan properly, you can repay it within 10 years. You should start SIP in mutual fund. That is the best idea, what I feel. As soon as your salary increases, your EMI remain constant. So what you should do, with the increased amount in your salary, you should start SIPs. And you should keep increasing that SIP amount year after year. And you will see that after 10 years, after a certain number of years, you will have sufficient amount to repay the balance. So 10 years, 12 years, depending on the returns, what you generate and how much you can invest. But that will be the best idea if you start SIP right from the second year when you start your loan.
Absolutely, which of course is contingent on having that amount of money available, which is why you said 40% of the take home is what you need to be paying on the EMI. Pleasure speaking with you, Pankaj. Thank you so much for taking the time. I'm sure that a lot of people will be much more confident when they go out and take their loans right now.